Hello, folks. Brandon Chapman with you today. It's another TheoTrade video for Monday, May 23rd, 2022. The title of today's session is Are Bonds About to Break Again? What about financials? It's one of those things where, if yields continue to rise, what's the indication? Is that a broader indication of a market sell-off as yields go higher and starts to pressure valuations and margins? Or maybe it's just a short-term relief rally in the market. Again, looking at the options market, looking at unusual option activity may give us an indication of where the market's positioning them and maybe how you might consider positioning yourself in a very uncertain climate. You'll notice today the S&P was up a paltry 1.87%. I say paltry only because the average move in the market has been very extreme. In fact, if we bring up here, we'll go to Edit Studies. I'm going to bring up an ATR study. It stands for Average True Range. And we look at the daily range from high to low or from the previous day's close to the next day's high and low is about $10.69 right now. Well, look at today. We're only up $7. The range is today is about $7.35. So coming in well below what's average. So as you might expect, does volatility decline with that? You'll see a modest decline in implied volatility today. So a decent rally below the ATR. The VIX is very stubborn in terms of its movement. As we've seen over the last week, we have seen skew come down and then pop up a little bit back to about 122. Skew is very volatile, but one of the interesting phenomenon is that we finally see the skew decline with a higher VIX and a lower market. We just have not seen that for a long time. Sorry, wrong one. We haven't seen that for a very long time where you get this kind of market clearing event down here at 115 to 120. But obviously, given the earnings trajectory right now and the concerns you have, of course, last week we had Walmart, we had Target miss and have some pretty significant downgrades, some bullish activity in Walmart. When Walmart drops 3 days like that, you might look at some trading, some trades like in and out spread, other things that might benefit by a little pop like we're seeing here. Maybe sell a put vertical. These are strategies we teach at TheoTrade where you can kind of benefit by this. Maybe we get a little bit more out of it. But the bigger implication is what? There is concerns about profits and margins. This is one of the three bears that I talked about in March that would affect the market as the future of earnings, not present, but future. Even companies like TTWO, for example, that had relatively good results for the prior quarter saw downgrades in their estimates for 2022 and 2023 earnings. That's adjusted earnings per share. But they're about to close out their acquisition of Zynga, ZNGA, and moving forward. So they did see a huge boost in earnings and revenues from the pandemic. And, the stock has, kind of fallen back here a little bit, back to historical levels of support. So the question is, what is happening right now? Are we looking for a relief rally in the broader market? We'll circle back here to take two in just a minute. But before that, we're going to talk about bonds. So we look at the TNX today, the 10-year treasury yield. We're up a little bit, about 0.72. Okay, so move that over a decimal point. The 10-year treasury is at 2.859. So a modest move higher today in bond yields on the 10-year. The 30-year, however, is about 0.69 as well. So we're setting up right now at a level of support in terms of yield. Could we see ourselves retesting the high around 3.2 to 3.3%? It's a very real possibility. And that may occur as the market is maybe seeing a little bit of a near-term relief rally and probably just resetting the bearish movement again, right? Since we're in a bear market. So the idea is we're at the top end of this trend line I've drawn here, the channel. If we start to break out here, we held the prior low. If we start to break out, we could see ourselves going to 415 or maybe 425. Maybe even 432. Oh, that seems more unlikely, but it seems reasonable. We could roll towards this kind of 410 to 414, 415 area. Is that what today's signaling? We may see a continued movement in this. Now we look over here, the top performers in the S&P 100 is JP Morgan, Citigroup, and Bank of America. These are all your kind of money center banks. Wells Fargo, Capital One Financial. Okay, now Capital One is a stock that we saw some significant bearish activity back here last week on Capital One and Discover Financial Services. Both had a bad couple of days there before Friday kind of settling in and rallying today. So we're going to look at some option activity amongst those names over there, specifically Bank of America, Discover Financial Services, BlackRock, that kind of thing. So anyway, BX, it was the other one. So Blackstone. So as we look at some of these names, we're seeing, the possibility within financials, a rise in yields would benefit financials, all things being equal. A steeper yield curve benefits financials, all things being equal. The problem is the Fed is out there raising rates, right? We're currently at 1% priced in on the 3-month T-bill. The Fed is expected to raise another 50 basis points again. So we'll probably see this inch up as we get closer to the meeting coming up in June. But here's the deal. For the near term, higher yields should benefit particularly banks that are involved in lending. So let's take a look at some of the activity in TLT today. Again, not expecting a huge move down, but maybe just retesting prior lows at 113, maybe even 114. So we look at the trade tab here on TLT. It was a 3 June expiration here. You'll see in here a 115 strike. We got a 112 strike. This is it's a long put vertical. It's a ratio. Again, if we come down here to the bottom, it was originally 10,000 contracts, I believe, if we come back in here. So 10,000 contracts for the 3 June. Notice we're being rolled here from the May expiration. We're selling the 12 there. We look down here, the 115 put for 3 June. We're buying in there. So we're buying 115, selling 112, and we construct this spread here. Again, looking for downside in TLT towards 112. Where's 112? That happens to be right about the low from May 9th. Okay, and so look, we're seeing a bearish trade. We're seeing some bearish movement, looking for a rise in yields and downward price in TLT. We also saw something similar to TBT, a little bit different trade, but as TLT goes down, TBT tends to go up. And as we look at the trade tab in here, we'll scroll down here to option time and sales. You'll see we're selling a 20 put to buy a 30 call and sell a 35 call. There's also a Jan in here as well. It's all for January. Again, what is this pointing to, right? So we'll come in here, the 20 Jan expiration. We're selling puts to basically buy some upside opportunity in TBT. And that's for January expiration. It's a ways out there. It's kind of a synthetic type trade. But again, we're looking for some near-term potential upside, even though that is a January expiration. It's occurring similarly with TLT. And again, probably expect this to maybe get to 28. Could we be a lot higher? Again, that's not my bet. I don't think we're going to be out there at 35 on TBT by January. But at least in the near term here, kind of a premium neutral trade. We're looking for some near-term upside in TBT. Again, dovetails with TLT. Now, as we look at these big money center banks like a Bank of America, for example, got a nice move today, up 5.94%. When you put this in perspective, though, I mean, look, we're basically back to where we were on the 17th, the similar price as we were, for example, on the 11th. All we're trying to do is tread water right now in Bank of America. We had a little bit of an uptrend right here, so we're going to draw a fib retracement from high to low here. Could we get to 37.50, maybe 39? Some prior support, now resistance around that 38.50 area. In Bank of America today, there was some bullish activity coming in for a 27 May. That's this week at the 35 strike price moved in the money. You'll see we're probably closing out some 36s out here, maybe adding a little bit in the 37.50 area. But point being is we did see early today some bullish activity coming at the 35. We saw some bullish movement in BAC. So kind of at the money. But again, could these banks see a little bit more stretch, a little more upside to 37? Yeah. But the bigger picture here is what? The Fed continues to raise rates, which is hurting margin. And what we're starting to see right now is that there's pressure being borne by virtue of defaults. Companies, for example, like credit card companies like Discover Financial Services that are holding on to balances. Again, this is when we saw a bearish setup last on the 17th last week. That was the last Wednesday, I think. No, last Tuesday. Bearish trade, that we saw some nice movement to the downside into Discover Financial Services. We also got it back here as well. Point being is that what we have is we're back up this area of resistance at the moment. Look back here, low, we got a low, we've got more lows here around the 110 area. And so we're seeing Bank of America maybe getting a little bit of near-term push to the upside, but now we see Discover Financial Services, and we're seeing a trade coming in today for the June expiration down here at the 100 strike for the 17 June. Again, mostly bought. As we look at where $100 is, that's back at support. So we're seeing, and we may see a little bit of upside here. You may want to see some reversal in the price, maybe a close below today's low as a trigger. But look at this thing going back to 100. So again, I'd probably reasonable look for a bearish trigger here. But again, the market's looking for potential movement down to 100. So maybe get another drift for a day or two in bigger money center banks like Bank of America. And we start to see a little stalling action in some of these other consumer credit companies. There was some bearish activity like ARCC last Friday. But again, we kind of held today. We got resistance here. Again, trading through the lows. Maybe we get some downside here in a stock like this. Was a roll to the, I think, a 17 strike. But that occurred on Friday. So look at some other financial stocks like Blackstone, for example. Large exposure, like the real estate market. Back up at resistance today. Look, prior support, now resistance. Resistance on around the 16th here. We're back at that same point again. And what we saw today was a September expiration coming in. And down here, not huge, but it's an $8 option. So again, notionally, that's a pretty decent amount of size coming here. Mostly buying at the $100 put strike. You can come down to time and sales and see, is it mostly, look on the put. We'll switch this to September. Was it one trade? No, I mean, it's kind of filtering here, a lot of it towards the close. Mostly buy side activity on that 100 put. Now, September, well, 100's right here. We could see ourselves looking to retest our lows. And again, look for a trigger, maybe a trade through today's low, looking for it to roll back towards 100 and maybe back to the lows from May. So again, more bearish activity coming into some of these names. Synchrony Financial, SYF. Again, a consumer credit company. So if we start to see more defaults, more issues in the housing market, people who make their mortgage payments, as inflation keeps rising, and again, we're probably going to see more food inflation continue throughout the course of the year and even into 2023. As we look at Synchrony Financial, the last time we kind of tested this kind of 35 area, we broke back down. We're back right around that same point again, not quite as high as we were on the 17th. But again, we might see this fade into this resistance here. And then and today on the on Synchrony Financial, it was a July expiration here. So we go to July 15. It was down here at the 31 strike. So a lot of puts being bought, mostly being bought at the 31 strike for 15 July. And again, 31 puts you a little bit below where the low was on May 20th. Okay, so again, we're looking at potentially bearish movement in these names. Now, one thing you can do as you look at the implied volatility rising, we have negative skew in these names. You can buy here and sell there, buy there and sell here. The idea is you're buying the lower implied volatility option. It's reducing your cost, increasing your reward to risk. You could even go shorter amounts of time where the skew is even higher. And again, getting a lower cost trade, looking for this thing. So you could buy a 33, sell a 31, cost you about 60, 70 cents on a 2-point spread. If we test 31 by expiration, you got upside of over $1, about a 2-to-1 ratio. Yeah, it may not be a terrible thing. We can see this maybe even pushes up another day, maybe provide a better opportunity, lower cost, looking for this thing to retest 31. So again, we're seeing this split right now, right? We're seeing bearish expectations right now being built in the treasury market. Again, I think largely due to the fact we're finding some support, money's on the margins being rotated from bonds to stocks, and that could continue for a couple more days. And part of that too, if you look at LQD, now LQD is an investment grade, it's a corporate investment grade bond ETF. Now, if I compare how this is performed against treasuries, that's IEF. And I'm going to go to studies here. I'm going to bring up what's called a pairs ratio study. It's just a basic study there. I've edited it just in terms of just color and the width of the line. What you're seeing right now is that, since April 4th, corporate bonds have really underperformed. So look at that, 1.4 was the ratio back here. We're now down to 1.08. We're at a similar level we were, for example, in early March. So if the market stages a little bit of rally here, there's a chance that, if bonds do sell off and we see more pressure in longer dated, 30-year bonds, for example, versus like 10-year or even shorter, there might be a chance here for the spread to come in between LQD and IEF, similar durations in those funds. You may see this have a chance to kind of move back up in here. And what this means is LQD may have a little bit of near-term upside if the risk spread between the two starts to come in. And what you're seeing here is an August expiration. It's out there a little bit for August 19th. What you saw today was this right here. So we're seeing a 114, 117 as an upside call spread. And you see it's a ratio. So there's not hugely bullish expectations. The premium received here will largely pay for, since they're selling two of these and buying one of those, will largely pay for the cost of this. So there's a little bit of near-term upside here. You'll see we're closing out some puts over here. But the idea is that, look, there's some limited upside potentially in LQD to the tune of about, lost it here, to maybe about 117. So again, if we look at the downward movement right here, draw retracement, 117 is only about a 61% retracement. So what does all this mean? It means that maybe there's some near-term opportunity for the market to stabilize and maybe rise for just a moment as we head into the next Fed meeting. And again, but remember, again, don't get lulled to sleep that we're in a bear market. And that's really what the trade today in Synchrony and Discover, for example, are at Blackstone, Deutsche Bank. It was a June 10 strike. So look at Deutsche Bank here. Don't get lulled to sleep. There are some real risks in the market to the downside. And remembering that this is a bearish market here, again, this just provides another opportunity to reset. And again, look at Deutsche Bank back at resistance. The $10 strikes here. Looking for some downside. Look for the stock to maybe trade through today's low as a trigger. Okay, so again, don't remember that. AGNC, bearish activity on Friday. Stocks up today. Again, you can look for that trigger, right? But again, keep watching these symbols. And again, that was a June 11 strike here. Sorry, July 11 strike for AGNC. It was on Friday. So watch these. Look for that downside momentum to turn, and you know where to position yourself. Right now, could you look for some near-term upside in some of these money center banks? Absolutely. Remember, though, again, it's near-term. It's limited in terms of the upside there. As the Fed raises rates, it's only going to hurt margins. As we wrap things up here for the video, I'm going to take a look at two other names. One is Take-Two. Now, this one's kind of interesting. They just completed, about to complete or did complete their merger or acquisition of Zynga. So here's 20. Actually, they did just complete it. So stop trading on Friday. Again, it's going to allow them. Take-Two makes a lot of video games, for example. My kids like a lot of them, like the sports ones, but, they had a huge boost to earnings as a result of the kind of the pandemic, per se. You see here, for example, $1.43 to $1.57 and dollar says this is 2020. Sorry. It's a little bit of a dip here. Then we saw it increase a little bit. Saw a boost in revenues. They did surprise the market a bit with their earnings. The stock did gap up. However, what we have seen over the last several days, we've seen negative revisions to 2022 and 2023 earnings. So while we're seeing some positives in terms of the Zynga merger, there is some diminution in some of the expectation after some of the pandemic growth in video games, particularly appreciation. But as we look at where the stock's currently trading, we're back against some pretty significant areas of support going back to 2018. Doesn't mean we can't see more downside here, but in the near term, kind of fitting with that little squeeze, today's rally certainly looks like maybe we could see another move. As we take a measured move of this run, could we see a move maybe back to 140? Absolutely. Now, as we look at today's trade in Take-Two, this was a June expiration, and it was out here at a 130 and 150. So we're buying the 130s, selling the 150s. It's an upside call spread. We're buying about 47%, selling 50%. There's a slight benefit due to the rising volatility term structure out here. But as we look at 150, where is that? 150 is up here, just beyond. It's getting back a little bit above. So the point being is that we're looking at this bounce and saying, hey, maybe we could carry to 137 to 143. Now, you might lower your expectations a little bit here and come down a bit, but could we get to 130? Could you buy here and sell here? The skew's not going for you at all, really, but at least it's going to be a pretty fairly priced vertical. Again, benefiting from the near-term upside potential in take two. Today's move is certainly helps that, some of the recent news, but the bigger problems of future sales guidance is an issue. So sometimes you got to close your nose a little bit. Upside call spreads are very cheap, high reward, lower probability trades, but it does give you the opportunity to trade the upside without all the risk. Turning our attention to one last stock here in Philip Morris. This stock had a nice bid today, did rally, we did fade back. We end up with a long-legged kind of spinning top here. Not super encouraging, but this is a company that pays a dividend. As we look here at the dividend yields, about 4.86%. You look at this company going back, 10 years, for example. Could we get back and run towards 123 again, or even running back to the high from the early of the year at 112? It's nearly $10 of upside from its present level. So again, this bounce is encouraging that maybe we could test that and maybe even run higher. This is a consumer defensive stock. The trade today was in a September expiration. Out here, we're looking at the 10,000 contracts of the 115 strike, mostly being bought. And as we look at that 115, we're looking at just slightly higher than the prior high here. So it gives us a little bit of a target and a time frame. But maybe, again, one to look at that, even if the market gets a little shaky, this does provide some yield. And guess what? You could even buy a put using the dividend. If you say I want to cover for a few weeks here and looking at the dividend here of $1.25, count forward 1, 2, 3, you're going to get paid in mid-June. Well, guess what? $1.25 might buy you about a $98, $99 put option for 25 days. It could also buy you a put spread, right? If you want some downside relief, if there was a sell-off towards an exit point, even going out to July here, right? The skew is going favorably for you. You could buy out here about a $90 strike price or potentially buy a $10 spread. No, that doesn't work. About a $10 spread going, $5 spread going 195 or 97.50 and 97.50 of risk reduced for a little bit of cost there. Once you account for the dividends going to get paid out here. So again, you can provide some element of protection in lieu of a market sell-off and benefit from the upside just using the dividend that's going to go ex-dividend here in about another month. Anyway, folks, that's the video for today. We'll catch you back next week for a Theo Night video. And Brandon Chapman with you. Have a great one. Thank you.